Hi, this is John Kosar from Asbury Research and Asbury Investment Management with your Daily 5. Here are my top 5 charts for this week in just 10 minutes. First chart, we're going to start big. I call it the game board. It is the S&P 500 and the key levels above and below the market. I think it's important to look for possible starting and stopping places of minor trends, and then we can bring in other indicators and try to determine which direction the market's going to be headed in next. So this is the S&P 500 going back to December of 2019. You can see we've got the 200-day moving average, which is the major trend, the 50-day, which is the minor trend. Then we have a Fibonacci retracement level based on the entire move down from the February 19th high all the way down to the March 23rd low. And there's various levels in there. The thing I wanted to talk about most importantly today is that we've been testing this major resistance at 2938 to 3000 for a couple of weeks or so now. That's important because this is major resistance. This is a 61.8% retracement of the entire move down from the February 19th peak. And it's also the 200-day moving average, which is mentioned literally every 10 minutes, seemingly, on CNBC and Bloomberg and other major financial news outlets. So we tried to get up there for 2 weeks, and we're failing there now. I see this as the line of demarcation to whether this rally off the March 23rd low is the start, or I should say the resurgence of this March 2009 uptrend line in blue that I'm pointing to, currently at 2506, or if this is just a corrective rally within an unfinished major downtrend that started at the February 19th high. So underneath the market, we have 2729 to 22, which are the June 3rd and March lows of last year. And also the 50-day moving average here, which comes in at 2715. So now we look at near-term direction. Which way are the market internals leading us? We have a metric, a model that we call the Asbury Six. And what the Asbury Six are 6 different metrics that we use to get an accurate understanding of under the hood market conditions on a daily basis. These are all based on closing levels. We actually update these on our website every day after the close or prior to the market opening the next day. I like to look at these as going into an art museum and having a sculpture in the middle of the room, and you're looking at it from 6 different angles all the way around it. So you have an understanding, a really good kind of 3D understanding of what you're looking at. In this case, 5 of those 6 are what I'd call secondary indicators. They're various internals like asset flows and volume and corporate bond spreads. Only one of these is based on the actual price of the S&P 500, and that's the monthly rate of change. So the reason I do that is 20 years ago, you could look at the S&P every day and you can have a pretty good understanding, a pretty good general idea of what's going on in the market. Not so much anymore. Algorithmic trading has really dominated volume. It's 75 or 80% of the daily volume now. There's a lot of head faking going on. So I look at these as kind of a lie detector for the market to really see what's going on and not which way the market jerked over the last 4 hours or whatever. So the important thing here is the Asbury Six had been on a positive reading since April the 7th. That changed as of the close yesterday, which was May 13th. You can see 4 of the 6 are negative. 4 of the 6 being the rate of change, the relative performance of stocks versus high yield bonds, investor asset flows in the SPDR, and market breadth in the NYSE Composite Index. So that tells us, in addition to testing and starting to fail at a major resistance level in the S&P 500, we now have the under the hood condition of the market is starting to turn negative. Here's number 3, market volatility according to the fear gauge or the VIX. This is another metric. It's not part of the Asbury Six, but another metric that I like to look at when I think the market is at an inflection point the way it is now. So this is the VIX down underneath here in the bottom panel with the 21-day moving average. Why the 21-day? It's one business month, and one business month is our tactical time period here at Asbury. So notice on March 31st, about a week after we bottomed on March 23rd, the VIX fell underneath its 21-day moving average. That suggested the market was taking a little sigh of relief, and at least on a monthly basis, the VIX was turning towards investor complacency. And that coincided with the rally that we've had since then. As of this morning, about an hour ago, I updated all these charts. You can see that the VIX is starting to edge up above its 21-day, which is currently at 35.85. If I start to see the VIX steadily trading above 35.85 over the next 3-4 days, that is going to tell me that this failure that we saw on the first chart is starting to show up in the VIX as well, and that would suggest a deeper decline, possibly into the minor support level that we showed, or maybe even back down to retest the 09 secular uptrend line. Stocks versus bonds, relationships matter. Another relationship that I look at to try to determine the health of the stock market is I want to see how the stock market's performing relative to the bond market. When I see the bond market, I'm talking the price of long-term treasury bonds. So what we do here up top is we have a relative performance chart of SPY versus TLT. And 21-day moving average, so we can get a tactical representation of what this relationship is doing. You could see on February 21st, stocks started to underperform bonds. That led to this big move down here. Underneath, you can see SPY. And then on April 6th, SPY stocks started to outperform bonds, TLT, and has managed to continue to outperform them through yesterday. But look where we are. We're right on that 21-day moving average. If we break there, which would be accomplished by SPY underperforming TLT over the next few days, that would suggest to me that we're in a situation where you might see another move down. Do I think it's going to drop another 35%? I don't know. I can't see into the future. But if stocks start outperforming bonds again, SPY underperforming TLT, that's going to kind of put another chip on the scale towards this might be the resumption of the larger downtrend that started back in February. Finally, where to be invested. We have another model, in-house model we use, and we call it the CARP model, and that's an acronym for cross-asset relative performance, or CARP. So what this does is it looks at 9 different relationships: stocks versus bonds, high beta versus low volatility stocks, large cap versus small cap, growth versus value, and so on, all the way down to 3 fixed income relationships down at the bottom of the table. And we use ETFs to measure those relationships in 3 different time frames: trading, which for us is 5 days, 5 trading days; tactical, which again is 21 business days for us; and strategic, which is 1 quarter or 63 business days. So what we're seeing through CARP is right now, just as of a couple of days ago, bonds are starting to outperform stocks. That is typically a defensive move by the market, and oftentimes will lead some kind of a period of weakness for stocks. You see large cap outperforming small cap. Again, that's typically a defensive positioning by the market, let's call it. And then you see growth outperforming value. Now you can see growth has been outperforming value on a strategic basis going all the way back to November 14th. And then, of course, govies here are outperforming corporate bonds, which again is another defensive leaning of the market in terms of relationships. So we have bonds, large cap, growth, and govies are outperforming. So to put all of this into perspective, it looks to me like the major downtrend that we started back in February is trying to re-engage here, and there's a lot of internal support that's happening. So the bottom line is be very careful here. This is not a place to put new money to work, and in fact, it's a place to start to design an exit strategy just in case what we're seeing here is indeed the reemergence of the larger downtrend that started back in February. So there's your daily 5 from Asbury Research. Thanks for watching.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.